So yes, this is a post-budget kind of analysis. We're looking at the salient points from a payroll point of view. So in 170 pages of budget documentation, we've picked out the bits that we think are most applicable to us and most applicable to the businesses that we deal with. So if I've missed minutiae on page 151, I apologize. It's probably an intentional omission, but we've covered most of the things we need to cover, I think. As ever, if there are things we haven't covered and you want to know more, then you're always welcome to contact us and we'll try and help you further. So this will be the last one we do this year. So this was hastily scheduled because this budget was more exciting than it's been for a few years. So we thought we'd better get in and make it sound exciting if we could. So we'll go to the first slide, which will give you an idea. So welcome and thank you for coming. So budget update autumn 2024, just for the avoidance of doubt. So we're going to look at the things that came up in the budget that affect PAYE or affect wage costs, affect businesses in the sense of payroll costs. So the most obvious ones covered in every budget in one form or another: tax and national insurance. Something always changes. It's been the vogue for quite some time to add some extra NI letters, but as the alphabet is only 26 letters long, I suspect they're saving them for a special occasion. So in recent years, we've had Freeport NI and we've had Veterans NI and all sorts of stuff, but they're running out. So no new NI letters this time, unless I've missed it. Employment allowance, obviously fairly significant changes to the employment allowance. So we'll cover that. National minimum wage, clearly a massive change in terms of business costs. And when you put that together with the changes in tax and national insurance, you start to get a fairly complicated picture. But the one sure thing is, if it's protecting the working person and making sure their wages aren't eroded, someone has to pay for it. And I'm afraid it seems that employers have a fairly, in labour's terms, broad shoulders, and they can bear the cost, I'm sure. Other changes, there are a few other little items, tidbits, interesting things or not, as the case may be. Salary sacrifice, when we're talking about national insurance and we're talking about increases in national insurance, then salary sacrifice becomes more attractive. So in recent years, it's been in vogue, salary sacrifice. Government obviously clamped down on a lot of salary sacrifice a few years ago to make sure it was only focused on areas that they consider worthy. But we'll revisit that. It's a rehash of my original salary sacrifice webinar. So there's no new material. If you suffered that, then you can go and get a coffee during that section if you wish. Budget forecasts, almost from the minute that the budget came out, we were starting to be asked for forecasts. What does it mean? So obviously we have all the information available. We have an understanding of what's involved, the impact on each part of the machine. So we can cover that in very briefly. And then, of course, if there are any questions at the end, then I'll try and deal with them, or we can come back to you with answers depending on the nature of the questions. So that's that. I apologize in advance. I haven't removed all the transitions in these slides. I hate transitions personally. Some people absolutely love them. So there are a few that have snuck in unnoticed that I didn't take out. So apologies for that. It'll annoy me than it annoys you, I'm sure. So national insurance rate. So these are the three actually principal changes. The other principal changes is on the next slide. So 4 things that were really significant. Number 1, national insurance rate. So the rate of employers' national insurance has risen from 13.8% to 15%. Yeah, a little number like 1.2% is so insignificant, but has a massive impact. Yeah, I mean, it's been 13.8 for a long time. They've obviously dabbled with employees' national insurance they being the government of the day, because obviously it's a different party in control now. But so employees have been the focus of the activity in recent past. Now the employers seem to be falling under the spotlight. So obviously there's a change in national insurance rate. Alongside that, there's a change in the national insurance threshold. That's the employer's NI secondary threshold. So that's the one that affects the national insurance that you as employers pay for the privilege of employing the teams and the people that you do. So it's not everyone will understand exactly how national insurance works, and therefore that shrinking of the threshold may uh, may have gone relatively unnoticed by some people. I'm sure it won't to you guys as employers because it's a cost. If it's a cost, then you focus on it. But very significant, that one too. Employment allowance, some significant changes to the employment allowance. One is just over doubling of the value that you can claim. So you can claim back up to £5,000 of your employer's national insurance charges at present. From April 2025 onwards, you'll be able to claim up to £10,500. And they've also removed the £100,000 threshold, which has been in place for several years now. Going back, if you guys who've been involved in your businesses for a long time will remember the days when you were able to claim that, employment allowance without consideration of your total employer's national or your total national insurance cost. Then there was a restriction put on place, which obviously reduced the number of people who could claim it. Small businesses could, larger businesses probably couldn't. So let's change that. And then there's a change, but no change in income tax. So income tax personal allowances have been frozen for a number of years, and that freeze will go on until 28-29. So the familiar 1257L tax code that many people see on their pay slips, they've seen them on their pay slips for 3 or 4 years now. Going back 5 years, 6 years, they used to change every year, start of every tax year. It would be changed because your personal allowance had changed. Even going back a little bit further, even changed mid-year on several occasions, causing panic and pandemonium within payroll teams and employers alike, I suspect. So that's tax and national insurance. Obviously, another extremely significant increase to the national minimum wage. Obviously, the stated aim is for employees, workers, the workforce, to be rewarded by getting more of their pay or getting more pay. So the stated objectives are to we're obviously raising the national minimum wage by 6.7% to those of 21 and over, but by a higher percentage for those that are younger, because the stated objective is that employees, ultimately, the age rates will disappear. They want everyone to be enjoying the same national minimum wage. Makes everyone's life simpler, also makes it very much more costly. And obviously, that's the one that's really been the focus of attention, now, because a lot of major players in hospitality and those type of industries have, it's a very significant cost. They employ a lot of those people. It's it's going to hugely impact their businesses. So that's the national minimum wage. Employment allowance, as I've just said, the employment allowance is increasing from 5,000 to 10,500, so just over double. The threshold's removed, so that's probably going to give a lot more employers access to the allowance. The other eligibility criteria, however, remain unchanged. So if you currently have difficulties establishing whether your business is connected to another business for the purposes of claiming the employment allowance, then I'm afraid the same problems will exist. So every year, it's an allowance that has to be claimed annually. So again, going back to its inception, it was something that you claimed and then it continued until your circumstances changed and you didn't want to claim it. Now you have to go through the process every year of assessing your eligibility declaring that eligibility to us on your behalf, and we will then claim it on your behalf. So every year we send countless emails out to people saying, can you please tell us whether you consider yourself to be eligible or not eligible? We do it to maintain an audit trail. We do it so that people are familiar with the employment allowance, understand what it means, and even if they don't claim it, that they understand they haven't claimed it, why they haven't claimed it, so that when their auditors or accountants come along and say, why haven't you claimed it? And then people come to us and say, why haven't we claimed it? It's about visibility, making sure everyone knows what's happening. So we'll still be sending those out, and we'll still be asking for a return, either eligible or not eligible. But the fact is, far more businesses will be eligible. We know that from previous years, and we know that an awful lot of businesses fail to be eligible because they exceed the £100,000 threshold for national insurance, annual national insurance. So, according to the government, I've plucked this one out because they were very keen to extol the benefits and how they were looking after certain facets and aspects. But this increase means that over 865,000 employers will have no national insurance liability. So can't argue with the numbers. If that's what they say, that's what they say. As I'll show you going through, for the majority of businesses that we deal with, it will probably be a net minus rather than a net plus. With the national minimum wage, it's almost certain to be. So, as ever with these things, going back, the employment allowance was introduced at the same time SSP recovery was removed. The remnants of SSP recovery, that is, because up until that point, you could only recover it if you were a very small employer. But it was one of those give with one hand, take with another. They gave us an employment allowance that said you can't claim SSP anymore, which broadly was probably swings and roundabouts, I guess. But the same spin is being put on the employment allowance now. The expansion increase in employment allowance will see an awful lot of employers have no national insurance liability, which is great for those employers. Other changes, I feel I have to cover other changes. I mean, one of the kind of things that is a positive, I think, in terms of business planning is at least some of these things are being put in the documentation, announced well in advance of when they're actually going to happen. So if you're a business planning or even an employee looking at a company car, what are the benefits, non-benefits of it? You've got some forward thinking, some ability to predict what's going to happen and make a judgment based on that information. A lot of stuff in recent past has been very knee-jerky. So this is at least moving in the right direction. So there are some changes to company car tax rates, as you might expect, still focus on green and electric vehicles. So, but they're starting to creep up now, the percentage, the benefit, which initially was, basically zero cost. You had to pay a lot for your electric vehicle, but you didn't get stung by the tax man. But clearly there's a direction of travel that's moving upwards as more and more vehicles are electric, I guess. There are changes in other cars with emissions and other cars without emissions. So basically, company cars are increasing, or the taxable benefit of a company car is increasing, should be specific. Company vans have been, a great benefit if you get the right van and you get and you can use it for the right things, and that's what you want to do. Because in relative terms, the tax charge on a company van and the fuel benefit associated with it can be very advantageous. And so the van benefit charge and fuel charges are being uprated by the CPI, Consumer Price Index. So they're moving forward, not at a massive rate compared with other vehicles. Double cab pickups sort of snuck through unnoticed. They they tried to sneak it through previously under another government, and it was fairly swiftly U-turned, I believe. But double cab pickups, this is really about the definition of when is a van not a van? When is a van a car? So you'll see sports utility vehicles, Chelsea tractors or whatever that quite clearly are designed for um, perhaps non-business use, but because of the treatment, they can be designated as a van. If they're a van, the tax rate is substantially reduced, and so they're a real benefit. So this is an attempt to ensure that people are paying a benefit in kind charge commensurate with the vehicle that they're traveling in. So it's designed to capture that loophole. Very significant increases for that type of vehicle. There are transitional arrangements in place, so the full effect will not happen for a few years, but it's, knowing it now, you need to consider what your fleet's going to look like. You need to consider when you're going to procure the vehicles and how you're going to move forward with that, because basically you need to sort of act before the end of the budget year, or fiscal year, I should say. So it's relevant to some businesses, some sectors, and some types of vehicles. Payroll and the benefits. So obviously the big news here for us is that mandatory payroll and the benefits in kind is going to happen. As it was expected to happen, it was announced in a previous budget. There were a couple of loose elements that they couldn't deal with effectively. Accommodation and interest-free loans, which you are now going to be able to payroll, but that is going to remain voluntary in the short term. Quite how it's going to work is still subject of debate, but ultimately, for us as a business, it's a huge thing in payroll in the benefits, P11Ds, the change from one to the other, management of that change. Putting it through the payroll is very different to piling it up at the end of the year and then passing it to us, your accountant, your internal finance team, to get those done. We've done separate webinars on payroll and the benefits. It's a big change, and we're currently looking at exactly what we're going to do in terms of rolling that out. We've had a few changes of thinking during the course of since it was first announced, compared with where we are now. But we will communicate with people in the very near future about the implications of that, how we see it working, and inviting people to potentially go early. So that's that. That's the other changes. So what does it all mean? I mean, I think this is a real slow burner of a budget. Is, at the top of it, I mean, I don't know how 170 pages compares with other budgets. Feels like quite a lot to me. But I think when you look at, the things that were in it, I think, the first few days people failed to react because they kind of couldn't take it all in, I guess. We were probably the same. But then you start to consider it and you look at it very much as it's one of those things that one thing is affecting another. So a change in the national minimum wage is impacting not only in the gross wage cost, but is obviously having a greater impact on your national insurance than it would have done previously. So you're having to change all the formulas in your budget planning documents to make sure they cater for the world as it will be compared with the world as it has been. So there are three scenarios here really, and yeah, one of the first things we did post budget was to, what does it actually mean? When you take in all the elements, what are we looking at here? So I've taken three scenarios. Your first one is an employee aged 22 who is working 37.5 hours a week. He's currently paid the national minimum wage and he's NI letter A. So actually, most NI letters will have the same impact because, but the table M national insurance wouldn't be exactly the same. But basically anyone over 22, the effect is going to be the same. sorry, over 21, over age 21, so age 22 or higher. So the NI rate and threshold changes will result in an additional cost for that employee annually of £998. So that's just the change if you left their salary untouched, which of course will not be an option. But it was worthwhile to us to split out the elements and see what actually was going on here. Get a feel for the clever people in the background who were obviously running various models with various things and trying to make it as palatable as possible, whilst bringing in as much money into the treasury as possible. So they seem to have achieved that, I guess. So NI rate and threshold changes alone, £998. So an additional £1,000 per employee in employer's national insurance cost. So you can already see that if you had 10 employees on the national minimum wage full-time, then your employer's employment allowance is gone. I mean, it's eaten up, it's offset. You don't have any benefit anymore. And if you're already getting some benefit from it, then 865,000 employers may be gaining a benefit. There are obviously significant numbers that aren't, because a lot of the businesses that we deal with have more than 10 people on national minimum wage. Add to that the cost of your national minimum wage actually making those additions to their gross pay, and you end up with £2,500 extra cost in your business. So pretty scary, really, I think. Then we obviously look at an employee who is on £30,000 a year, 37 and a half hours a week. That the number of hours they work is not relevant to this calculation. It is relevant to other things. So what would it look like for them? So there, the effective NI rate and threshold changes on those guys, they're putting in £864 on your bottom line. Oh, sorry, off of your bottom line onto your costs. So nearly £1,000 if you do nothing with their salary. So total increase £864. Then we probably move into the real world where if you're bringing everyone at the bottom, national minimum wage workers up by 6% or 7%, 6.7%, you're bringing younger workers up even further. Are you really going to get away with giving nothing to your higher paid workers, higher paid in relative terms? The reality is probably not. So we looked at obviously a scenario in this case where that employee who was on £30,000 a year had a 5% uplift. So not quite as much as the national minimum wage, a little bit more than current inflation rate. And what does that look like to your business, to the costs for your business? What that looks like is an NI rate increase and threshold change impact of £1,089. And obviously an increase in gross pay of £1,500 to keep that employee happy in the face of his junior colleagues potentially having significant increases. So total increase there is £2,500. So I think if, just look at those three employees, if they were in your business, then, well, it's actually two employees because we're looking at two scenarios for one employee, but potentially £5,000 on, onto your costs. So not insignificant. Then you've got additional employer costs, because this is just the effect of the NI rates and your national minimum wage. If those rise, other things rise in tandem with them as an effect. It's cause and effect. So one thing rises, everything else does. So notably, it's your holiday pay. Depending how it's paid, you probably won't notice it with a salaried worker, but you certainly will in other circumstances. And your pension, obviously, almost everyone's in a pension these days because of AE legislation. And if one cost goes up, then another cost goes up, pension goes up. All right, it's perhaps relatively insignificant when you're looking at all the numbers, but not to be ignored. And then the employment allowance increasing by 5,500 or 10,500, depending whether you're currently claiming, not claiming, and of course, if you're eligible for the coming tax year. So that's a little bit of money given back to you, but I would venture to suggest that perhaps it isn't as much as you're shelling out. But that's for another day, or another slide in this case. So here we have some transitions. Don't you just love them? So I never miss an opportunity to talk about salary sacrifice, because the government still allows some beneficial forms of giving up part of your wage in return for a benefit. The notable benefits that people receive are pension contributions, bicycles, childcare vouchers, annual leave, and computers and tech is another one that's fairly common. So those are the common ones. Salary sacrifice arrangements do necessitate contractual change, so they're not something you can do without adequate planning, consideration, doing the right things in the right way. But they are an opportunity to mitigate the cost or the increased cost of employers' national insurance potentially. If you reduce someone's salary, then by definition you're gonna, or their tax and NIable salary, which is what a salary sacrifice will do, then that means that their employer's national insurance cost will also be diminished. So it's been very popular in recent years, you know, as people have sought to look at other opportunities to give an enhanced remuneration package to their employees without or at reduced cost. And salary sacrifice pension contributions is a great way of doing it, both as one-off, you know, if you pay bonuses, some people will now choose to put it into their pensions. You can facilitate that change. Or because people are more clued up and they ask the question, can I contribute through salary sacrifice? So now it's more beneficial for employers. So that's the basic salary sacrifices in place. Pension basics. I'm really going to spin through this because I've done enough webinars on pensions and salary sacrifice. But there are three types of pension. You 3/4 relief at source. The majority of pensions we administer are relief at source. Net pay arrangement. There are some net pay arrangement pensions around. If you have a workforce with workers low paid, or low paid is obviously they're going to be more highly paid in the near future, but also people working flexible hours, less hours, their salaries are lower, possibly because of the way they work rather than the fact they're on a reduced hourly rate. But those type of people, if you're in a net pay arrangement or they're in a net pay arrangement, you as a business employer provide pension through a net pay arrangement, then they may miss out on tax relief. So if I'm ever asked about pensions, relief at source is fine. Everyone gets tax relief, even if they don't pay tax. Net pay arrangement, you only get it if you pay tax. A lot of people don't pay tax, so they don't get a benefit from that. They actually lose. And then salary sacrifices, you get the benefits of a tax saving and a national insurance saving. And that NI saving is to you and the employee. There's a point at which relief at source, or there are people for whom relief at source is right. There are people for whom salary sacrifice would be beneficial. There's a bit in the middle, which makes managing salary sacrifice a little bit more tricky than it would otherwise be. And when you're seeing significant rises in national minimum wage, that can also make something that was advantageous less so. You wish you hadn't done it because you find yourself with a salary sacrifice scheme that works for the employee but not for you. So that's the basics of pension. And then I suspect what's on the next slide is, yeah, load of stuff. All I'm doing there, you can read it at your leisure. I'm sure we'll send the slides out and it will be on YouTube, making the point that there is a national insurance saving for the employee. So if an employee contributes through salary sacrifice, more money goes in their pot than it would otherwise do if they contributed via net pay arrangement or relief at source. So that's from the employee perspective. So better for the employee, albeit less better than it was when the employee rate of national insurance was 12%, because now it's 8%. There's less of a saving, unfortunately, for them. So that's salary sacrifice. Pros and cons, quick run through of pros and cons, really with reference to salary sacrifice. So relief at source, non-taxpayers benefit from a 20% uplift in contributions through tax relief. Indeed, they do. So everyone gets tax relief. If you're higher rate or additional rate taxpayers, you have to claim your relief. So if you're a director or a chief exec or whatever, then you wouldn't naturally get all the tax relief to which you're entitled. You have to work for it. You have to claim it either by contacting HMRC or through your tax return. Net pay arrangement, as I've already alluded to, not keen on these. I think they, yeah, they just don't give some people any benefit at all. Immediate tax relief at employees highest rate of tax. So they do work for a higher paid person. They don't have to make a claim anymore. It happens naturally. So if you were, a group of lawyers and you were paying yourself astronomical salaries, then perhaps that would be the right route for you. If, however, you're in the care industry or the hospitality industry, it may not be right for your employees. So non-taxpayers don't get any relief. That's the biggest downside of it. And disadvantages lower paid workers, which is exactly what I've said. Salary sacrifice, immediate tax relief at employees' highest rate of tax, but important to note, lower paid workers wouldn't get tax relief. So it's not right for everyone. NI saving reduces the employee pension costs, so it's better for the employees. And the employer NI saving reduces the cost to the employer. So it's a good idea for employers. And it's a better idea on the 1st of April than it was on the 31st of March or 6th of April rather than the 5th of April, depending when your pay periods are, etc., etc. But at a point in time, it becomes better than it was. You have to steer clear and be wary of national minimum wage compliance issues when you allow people to contribute via salary sacrifice. As the national minimum wage rises, those potential compliance failures become easier they can happen more easily. They are more unexpected. So you have to be far more aware of them and the impact they might have. And it affects entitlement to statutory payments potentially. Usually the benefits offset that, but people need to enter these things with a clear idea of what it is, because in these days it's the worker's responsibility to make sure these things are right for them. You can't force them into it, but they have to make a choice and they have to make an informed choice. So that's salary sacrifice. Example scenario. Gosh, yeah, we don't just spin through that. Yeah, spin through that if you want to. Basically, when I did my pensions webinar, and I was looking at the potential savings for a salary sacrifice pension, I looked at everyone in the. You move on to the next one, Bell. If you want, that's it. We won't bother with the finer detail. But I reckon across our business or across the employees that we administer, the pension pot at retirement through salary sacrifice would be enhanced by the difference between, what's that, about 4 million, 4.2, 4.3 million pounds. And obviously, if you've got a increase in the employer's national insurance rate, the saving, this is if the employer saving is added. So basically, in basic terms, there's more money to be saved for all. I think we'll leave it at that. We'll do that in another webinar. I'm sure highlights are on YouTube somewhere. I'll never find them because I'll never look for them. Salary sacrifice holiday arrangements. So it's another form of salary sacrifice. This one is definitely a growth area as well, as people seek to work more flexibly to get the work-life balance right. Then management and flexibility around holiday is far more popular than it was. Obviously, salary sacrifice holiday arrangements, because they're a salary sacrifice, there will be an NI saving there to be had. There are also national minimum wage compliance issues to be considered. But it's the two popular salary sacrifice options, and the ones the government has not attempted to subdue in any way, are salary sacrifice pensions and holiday arrangements. So we can talk to you about those. Some people have them in place, some people don't. For some, they're a godsend, and for some, I'm sure they're more of a pain in the neck. But pay your money, you take your choice. All we can do is flag them up. And finally, I think this is the final slide actually. So I've rifled through this, which is great. So budget forecasts, as I say, almost from day one, post-budget, we were asked if we could forecast, do some budget forecasts, if we could tell people what it would mean for them in financial terms. And of course we could. We're experts at this sort of stuff. We know all the things, all the things that will affect those costs. We can consider them in fine detail. We have all the information at our fingertips. For most people, we have, if you want to make a comparison year on year, we can make a valid comparison with a pay period that you consider to be, representative, or we can do them in a broader way. So we have already, set out to do some budget forecasting. And we're more than happy to do it for anyone who needs it. It is a chargeable service. We make no apology for that, because ultimately there's quite a lot of work involved. And what we would do is help you to consider national minimum wage is national minimum wage. That's the easy bit, really, I think. We can tell you what the cost of that is, but then most business owners and managers will have an idea of what that means to their workforce, what they would need to do to their other workers to lessen any potential problems in the workforce that might be generated by different people by wage structures being compressed. I think that's been the basic problem from the inception of national minimum wage. Wage structures have been compressed. There used to be clear demarcation between junior this and senior that. Nowadays, they're very within a very sort of very close to each other. But what we can additionally do is look at the scenarios in more detail. So you can look at your workers. This is your national minimum wage paid workers, and this is what is going to happen. Those are the costs that will be incurred. Almost you can do nothing about those, although obviously you can look at your workforce in its entirety and do you need more or less of them. But what you can also do is plug in percentages for other workers. So if you consider that you're looking at a 3% cost of living increase or a 5% increase, then we can obviously help with those, plug those numbers in, not only tell you what the effect is on gross pay, but what the effect is on your national insurance charges, what the effect is on your pension charges, etc. So it's a broader look at the costs. So big businesses will do this. Yeah, we've shared with some employers their workings, the way they've approached it. We often get involved in budgetary talks with people, larger businesses, just to make sure they haven't missed anything out, really. But we can obviously provide that to businesses of any size. I think some people will be quite surprised at the impact it has. I was quite surprised. I mean, we've got a business with 8 people, so we definitely fit into a small business category, in my opinion. But yeah, it's quite scary, really, when you look at the impact of all those 3 things together. The impact on the wider world, the job market, the way wages will move, etc. Don't want to go into it with your eyes closed. I don't think that's for sure. So we can help to open them. We can provide you with that insight, should you wish. So we're always there for that type of stuff. Same really relates to salary sacrifice pensions. I talk about them a lot because we talk about them a lot, because we're asked about them a lot. but we can help you with those things as well. So some people will naturally go to a pensions planner and ask them. They won't have all the information we've got. They probably won't have, as clear a picture of it as we might have. So if you're thinking about implementing salary sacrifice pensions in your business, again, we can help. We can help with the mechanics, and we can help with the education, because we set out to educate people in pensions. They're such a huge part of what we do in payroll. And I say probably on every webinar that we used to be payroll and pensions, and now we're pensions and payroll. But it is so true. We ultimately probably talk more about pensions in our business than anything else. So it's unsurprising that that's the case. Really, everyone is forced down a pension saving route at a very early age now, and in the pipeline are changes to that will make it an even earlier age, and even more people will be encompassed within AE legislation than are currently. So it's only moving in one direction, saving for the future. Someone has to do it. If the government steps away from that responsibility, someone else has to step in. And the fact is, you can lose important benefits through lack of awareness. So we try to change that. We want people to understand it. So that's it. I think the next slide